Hello and welcome to Livewise Income Series for 2024. I'm Sarah Allen and today I'm joined by Andrew Lockhart. Andrew is the Managing Partner for Metrics Credit Partners. Today we're going to take a closer look at the Australian credit landscape. Andrew, welcome.
Thanks Sarah, nice to be here.
Private debt has been one of the fastest growing segments of the Australian landscape. What's driven this, and do you think that growth is going to continue, accelerate or slow down, and why?
I guess the asset class has been attractive for investors. So when investors are looking for defensive characteristics around, fixed income, they've sort of had a situation in public bond markets where their returns have been adversely impacted as a result of rising interest rates. There's been more volatility that's impacted investor returns, and so investors are generally looking at this asset class to deliver two things, which is one, obviously stability of capital, but also deliver an attractive source of income. And so you've genuinely seen investor demand continue to increase. At the same time, you've really got private credit managers that have invested in origination capability to really be able to source and find good lending opportunities. And so the ability to raise capital and then to deploy it sensibly to drive appropriate returns has sort of seen the asset class become attractive and well accepted within the market. And I guess now we've been operating now for over 11 years, and so I guess investors can see a long track record of performance and delivery. And so when you think about the asset class of private credit, there's a lot of features that are attractive for investors. Where you sit in the capital structure, the terms, the conditions, the covenants, the security, all designed to protect investor capital. And as your business grows and your funds grow, you're able to reduce investor risk through greater levels of diversification in terms of the holdings. You can only do that to the extent you've invested in origination capability. And so, the asset class is attractive. The funds that investors can now access that are well diversified, lowering investment risk, means that the asset class is delivering on those stated objectives of stability of capital with an attractive source of income. And it really, in comparison to a number of other asset classes, it's demonstrated resilience in terms of performance. And with interest rates rising and the total return increasing for investors, it's again demonstrated the attractiveness of the asset class. And when we sort of look at the macro position in terms of the regulatory impacts on the banks, I guess over time we continue to expect that the banks will reduce their lending activity, and private market lenders should increase that availability of funding. But also importantly, we've seen very strong demand from borrowers looking to access an important source of non-bank finance. And so that ability to match appropriate capital from investors to the appropriate assets to deliver a good return for investors, to be able to manage risk sensibly, I think has delivered a really attractive investment proposition. And as a result of that, we continue to expect the asset class will continue to attract investor interest. But of course, like all things, you're only as good as your performance. And so, the fact that the market has responded to a decade of good performance sort of gives me the confidence that credit growth will continue to grow. Financing demands from borrowers will continue to grow. And so therefore, providing and delivering on investment objectives, then obviously, you'll have the available capital to meet the demand.
What impact do you think a slowing economy and a hard landing would have on the private credit space, and what probability do you assign to this happening?
I guess at the end of it, you need to think about where you sit in the capital structure. If economic conditions were to deteriorate and be a hard landing, as you say, it would be more likely that risk is really borne by shareholders and equity. So if you think about that capital structure, investors are investing in equity to see the company's earnings growth, and as a result of that, hopefully valuation increases and therefore share price increases. If we go through a situation where earnings decline and valuations compress, then obviously the asset class that would experience the most volatility and potential risk of deterioration in their portfolios would be equity. So a lender obviously has the protection as a result of the equity that is invested, which aligns the interests of shareholders and a lender. So in a situation where economic conditions deteriorate and you get some slowdown in economic activity, what you tend to find is that lenders become more cautious, and so the terms and the conditions become more onerous. It actually means that you're kind of lowering risk against the companies you lend to. And often in those circumstances, what you also find is that the availability of capital becomes scarce, and as a result of that you get a widening in credit spreads. So often in a situation where economic or business conditions deteriorate, you actually might have more conservative structures that generate higher returns because of the conservative nature of lenders through that process. So do I think it's likely to happen? I don't. I think, if you look at our economy here, we've got a very strong economy still. Unemployment's very low, immigration is strong. If you think about the housing sector, you've got very low levels of vacancy, rising rents. A lot of those sorts of things create demand for housing, and residential development activity is a significant area of activity for us. And so we again will look at each different industry, the companies that operate in those industries and those sectors, seeking to find the appropriate lending opportunity, and then we would obviously structure terms and conditions with those borrowers to mitigate any potential risk of downside. So as a lender, when you're entering into a transaction with a borrower, you're forecasting out the company's cash flow and their capacity to service and repay their debt over the term of the loan. It's not as though we simply say that economic or business conditions are going to remain stable or improve. We obviously sensitise those transactions to ensure if there was a deterioration or a hard landing, that we've got an appropriate setting in terms of the capital structure to mitigate that kind of deterioration in business or economic conditions. Again, these are the ways in which a lender seeks to protect investor capital.
So when areas of the market grow quickly, such as we've seen in private credit and private debt, it can be a bit of a bumpy ride. And there have been some areas of concern, such as valuation and in the construction sector, particularly around property loans. What are your views on this, and how are metrics steering clear of these sort of concerns?
Look, I think at the end of it, it's an interesting question, because the idea about valuations or transparency sort of is the wrong question to ask. Because really what you're sort of saying is that, in our own case, for instance, and I know this is the case with a lot of private credit managers, they often have an independent responsible entity or trustee that oversees their activities. They often get independent market valuations and the testing of impairment to ensure that there's an appropriate independent party that can assess the carrying values of those assets. Now, unfortunately, in the assessment of private credit, you've got issues around the credit rating, the fact that the loans that are provided to a borrower are confidential between a lender and a borrower, and so that degree of openness and transparency isn't available like it might be in a public market. Loans are not generally traded, and so the fundamentals of what you're lending for is really, we're not traders, we're lending on what we call a hold to maturity basis. So we're effectively saying we've assessed the risk of providing financing to this company, and we believe that the company can generate sufficient cash flow to service and repay its debt during the term of the loan, and then on the maturity, or by maturity, we expect to have multiple ways in which we can exit our position for repayment of our facilities. And so credit quality is the most important thing in terms of how private credit or investments in private credit might impact an investor. So obviously, sensible lending with appropriate terms, appropriate conditions, appropriate covenants, appropriate security in an appropriate capital structure. A lender will lend on those terms and conditions on the basis that you're seeking to mitigate risk of loss. So valuations, if you've lent $1 today and at the end of year 3 you've received all of the interest and fee payments and you're receiving your principal back, the issue around a valuation is not as significant, and you don't tend to find in other asset classes significant volatility in the carrying values of loans. A performing loan is often there'll be pricing grids and there'll be controls and mitigants within the structure of a loan designed to negate any deterioration in credit quality or market conditions. So as it relates to real estate markets, again, it's quite different. You know, people often make the mistake of thinking in terms of the equity ownership of the real estate property. They're concerned about a decline in valuation impacting their financial position. But that's really, again, a risk that is borne by the owner of the property or the equity or the shareholder of the asset owning entity. For us as a lender, there's obviously a buffer of equity. And so when you think about real estate related transactions, over the last number of years, there's been a number of challenges as we've dealt with rising construction costs. We've dealt with a lot of significant inclement weather, supply chain disruptions through the COVID period and post-COVID period, availability of labour. These sorts of things are, things that have gone on in the industry and sector as our clients have developed their properties. But our role as a lender is to ensure that we've mitigated any potential risks that may come from those things. And so there's appropriate contingencies for costs, appropriate contingencies for time, finance costs, and then monitoring the loan as you're providing funding as the building's being completed. And so what we've actually seen in our portfolio, we have predominantly a skew towards residential and industrial development. And so again, if you look at the fundamentals of that market with very strong consumer demand for residential housing, tight labour markets and rising immigration and low vacancy rates and rising house prices, it's actually been a market where we've seen very strong demand for the end product, which is again the key source of repayment of our facilities. So we're not lending on the basis that we're going to receive just simply an interest a cover from the rentals. We're expecting to generate full repayment of our facility as the property is sold on completion. So and it's quite different when you've actually lent against pre-sales. So the pre-sale contracts gives you confidence that subject to the delivery and completion of construction, you've got a known source of repayment.
What's the deal flow been like lately? And of the last 100 deals that have hit your desk, how many are you pursuing?
Deal flow is always reasonably strong. You know, we would ordinarily run a work in progress pipeline well in excess of $10 billion. Across our business, we have significant quarterly liquidity through regular repayment and recycling of the loans that we've made. And so those loans we provided, say, 3 years ago, they come up to maturity and we're being repaid. And that's a constant feature across all of our various funds. But generally, we would sort of look to do around about 20% of the transactions that we would see across the broader market. Some of that might be because we can't agree the terms or the conditions or the pricing with a particular borrower. There may be times that it just doesn't naturally fit in terms of the portfolio parameters that we're seeking to achieve. There could be a whole range of reasons why we may not proceed with a transaction, but it's generally around about 20%.
So talking about the direction of interest rates has become a bit of a national pastime, but not really at Metrics because you guys use floating rates. Can you explain this for investors and give an example?
The majority of loans that we make are subject to a floating rate, which is a market-based rate. So loans generally price off what we call the bank bill swap rate, or BBSY, which tends to be at a slight premium to the bank bill swap rate. That effectively represents the cost of funding that the banks have to generate, that they're prepared to lend against, right? So it sets the baseline in terms of the cost of funding. So loans are priced over BBSY, and to that you will charge a margin for the credit quality or the risk profile or the loan term or the industry or the size of the transaction. It can vary. So there are different segments and precedents in loan transactions where pricing may change depending upon your counterparty. The risk profile, the credit rating, the term of the loan, the industry, the size of the facility and the like, all of those factors come into play. Plus also there's a return that's generated through the fee income that's charged to a borrower as you originate and structure the transaction. And so that whole combination of fees, margins, together with a floating base rate is really what drives the revenue that is generated for our lending activity that becomes the source of income for our investors. So when you look at that, obviously as interest rates have gone from 10 basis points with the RBA cash rate now at 4.35%, there's an immediate flow through because the market pricing of the bank bill swap rate reflects market conditions and investors' expectations around future interest rate moves. And so loans tend to price between 30 days, 60 days, 90 days, and the borrower can select an interest period, and that sets the base rate for that period of time. So if a borrower, say you're completing a large construction facility, the borrower might have to pay subcontractors on a monthly basis, and so they will generally draw their loan facility for 30 days. And so of course if interest rates are rising and you're resetting that base rate every 30 days, it's almost an immediate transfer of that higher interest rate that the market has derived that is then paid to the investor. And so those floating rates just mean that there's no general lag in terms of when that income is paid to investors. That's the income that's generated on all of our lending activity. So the same applies if interest rates were to decline. If interest rates were to decline, then that total income to an investor, being the base rate, the margin and the fees, might decline in line with market expectations. So it's not like we're lending on a fixed rate basis and taking duration risk. The loans are short dated, floating rate. And one of the things that we've always done at Metrics is we've sought to reduce investor risk through shorter dated exposures. We think that it reduces investor risk from a credit perspective to have a shorter dated exposure. Certainly reduces market risk, so if interest rates were to change or market margins and spreads were to change, you're less exposed to that. As you're lending for shorter periods of time, you get greater levels of volatility and recycling of capital, so greater liquidity through the funds as loans are being repaid on a more frequent basis. And that also gives you the ability to generate additional fee income. So every time we recycle capital and on-lend that to the next company, then obviously those fees become an important source of income. So for us, what we're trying to deliver for our investors is not just simply a passive income flow based on a base rate that may float or not. We're in there seeking to ensure that our investors are rewarded appropriately, that we're charging the right margins and fees for the capital that we provide. And we believe that the non-bank financing that we provide to companies is a valuable source of diversification and non-bank financing. And so our investors should be appropriately rewarded through appropriate margins and fees to deliver an income for our investors.
What's the biggest question you typically hear from your clients and investors, and how do you respond to it?
Obviously, the biggest question that we get is always concerns about the credit quality of the portfolio. And I guess that's a natural position for people because we're lending across a number of companies and sectors and have a number of counterparties in our portfolio. And so people will naturally want to know more. But unfortunately in our business, the loans that we've made to an individual company are subject to confidentiality obligations, and so we can't explain to our investors the terms and conditions and the risk profile for each individual borrower. But we obviously undertake detailed credit risk ratings. We subject our portfolios to independent review to be able to give our investors confidence around the makeup of our individual portfolio. But interestingly, I think about the asset class, and I think private credit is a very attractive asset class because of all of the actions that a lender can take to protect capital through those covenants, through those controls, the taking of security, by requiring additional equity to be held. All of those things are designed to protect and preserve investor capital, and these are contracted obligations that the company has entered into with a lender. But importantly, what you're trying to also do is to lower investment risk by well-diversified portfolios. So you're looking to reduce your exposure to any one individual counterparty. And so like for instance in our listed funds, MXT, we have a stated position in that fund that no position in the fund can exceed 5% of the value of the capital of that fund. And so from a position size, we've diversified our portfolio across 300 individual borrowers where we're well inside that maximum threshold. And again, part of our role as a lender is to not only lend appropriately, but then also provide investment products that can further reduce investor risk through appropriate diversification and low single counterparty exposure.
How do you see things evolving over the next 12 to 24 months, and how do you expect that to impact your portfolios?
We're not really subject to market risk events and those sorts of things. We lend on what I believe are appropriate terms and conditions. We're across the detail of all of our individual exposures. We have deep relationships with the companies that we've provided financing to. We're across that level of detail to ensure that we understand any known or potential risk that might come up. Now, obviously, you can get an event risk that may come up, but for us as a lender, that risk really is a risk that is borne by shareholders and equity. You know, the volatility of the asset class should only be exposing investors in the equity to that kind of risk. For us as a lender, you know, we should be well protected. And when you set a loan transaction and the structure of a loan, you're designing the capital structure to ensure that the company can withstand a deterioration or event shock, and that you're not so highly levered that, you know, the first sign of trouble causes a problem for a lender. So certainly from our perspective, I don't anticipate, you know, that we're in now our investors' capital is well diversified across numerous borrowers, over 300 for, say, our listed fund. So again, our investors' capital is well diversified, majority of which is senior secured positions in the capital structure with highly competent management teams, highly competent boards and companies that are performing strongly. And so as a result of that, obviously we want to monitor and manage the risk of that, but I don't anticipate that, you know, there's going to be some event that is likely to cause a problem across our activities. I guess I've been doing this for a very long period of time, and certainly working in banks and others, you're not responsive to market movements on a day-to-day basis. You know, the lending that you're making is on the assumption that, you know, you've looked forward over the term of the loan and you've positioned the exposure with an appropriate capital structure to withstand that daily volatility or potential risk.
Thank you so much for sharing your insights with us today, Andrew.
Thanks very much, Sarah.
If you've enjoyed this interview, please subscribe to Livewire Markets to watch more of the Income series. Thank you for watching.